Well, welcome everyone. We now have over 50 people joining this event, so thank you very much. And over the next 45 minutes or so, we plan to lift the lid off the mysterious world of third-party marketing. My name is Nigel Silito, and my task today is pretty straightforward. I'm here to ensure we don't overrun. I'm going to try and keep it to 45 minutes because I appreciate you're all living very busy lives. Keep everyone engaged, so please do use the chat box if you'd like to ask our speakers any questions. That's through, as I said, the chat box, and obviously I'm going to manage the slides as well. So this project, just to introduce everyone, was only made possible with the support of Stephen DeVray, who's become a very good friend of mine. As many of you will be aware, he used to be head of European sales and global distribution at Janus Henderson. And we were also backed by 3 platinum partner companies, which I'll come on to in a minute, and 4 leading third-party marketing companies, which going forward, I will refer to third-party marketing as TPMs. Our speakers today, I'm pleased to say, represent all spectrums of the financial services industry, based in many countries. It's rather like the Eurovision Song Contest because we have contestants from the Republic of Ireland, from the UK, from Germany, from Italy, from Israel, and from Holland, which is where Stephen's based at the moment. The only topic which is not allowed today is football, because obviously there are many Germans who've dialed in. So there's a big game, England versus Germany. So please, nothing through the chat box about anything related to football. But why don't we kick off by introducing our partners for this exciting project. So I'm going to kick off with our platinum partners first. So just bear with me while I bring up the slide. So without the support of these companies, it wouldn't have actually been possible to have made this a viable project. As I said earlier, they come from different spectrums of the financial services industry. On the far left, we have Stuart Alexander, who runs GemCap. Then we have Gail, who's in Dublin at the moment, who's a partner with that very well-known global law firm, Pinsent Masons. And then we have the legend, as I like to call him, Pat Sanderson, who you may recognise played for England rugby quite a while back, I believe, Pat, and is head of UK and Ireland client coverage. So these were our lead partners in the project, and they are the ones who've also added thought leadership articles to our report, which will be circulated tomorrow. But the added spice is the fact that we managed to involve 4 leading TPMs across EMEA, and the focus very much is on EMEA. So starting from left, we have Cor Ducker, who is managing director of his own TPM. Sorry, just bear with me one tick. Garnell. Then we have Luke, who's currently residing in the UK, who's partner of LGBR Capital, and Andreas, who's managing director of Active Fund Placement, and Avihai David, who's CEO of More Global Markets. It's unfortunate I've never met any of these gentlemen running TPMs, but hopefully that will change, particularly with you, Avihai, now that the relations between the Middle East and Israel have cooled. So soon I hope to jump on a plane to Israel, so it'd be great to actually meet you in person. So that's by way of a quick introduction. What I'd like to do now is just quickly pass you over to Stephen, who's going to look at the definition of a TPM and some of the myths before we look at the survey results, and also look at the TPM practitioners, because I think it's very important to find out what they're saying about their particular markets. And as I said, we're represented in Italy, UK, Germany, and Israel. So I think that's going to be a really fun part of this webinar. So Stephen, if you don't mind, over to you.
Yeah, thank you very much, Nigel. Yes, so this project sort of came about after I left Janus Henderson, and I got involved in a few projects that involved third-party marketing. And for me, coming from a large organization, was a fairly unknown part of distribution in the asset management industry. And my knowledge was sort of what a TPM is, was based on the traditional biases and myths. TPMs are usually one-man bands. They're salespeople who lost their job and trying to use their Rolodex to set up their own business. They're very transactional, very short-term driven. They charge a fortune, and they focus mainly on alternative investments, so say private equity and hedge funds, and they're usually not regulated. But as I started interacting more with third-party marketers in the EMEA region, I started to realize that actually that idea was completely wrong. And I got more interested in who TPMs are and what they are. And I think the conclusion was that a TPM 2.0, sort of the modern third-party marketer, is much more about outsourced marketing and sales, and that includes branding and relationship management. And so, particularly for small to medium-sized asset managers, a TPM is a really good alternative to hiring salespeople or setting up an office, which can be quite time-consuming and very expensive. I also realized that there was not much information available about the TPM industry, and that's when I connected with Nigel Soto about, well, can't we explore this market? Can we collect data, do a survey, and put this data into a report that we publish, and sort of dispel some of those myths? So, and what came out of my understanding, and what you will see later on in this presentation as well, is that it's a very broad range of asset classes that are being covered. There's a lot of long-term relationship management-driven TPMs around. A lot of firms are much more than just one person, and actually, it's also surprising to see that quite a lot of them are regulated. And if they're not, it's also sometimes because the local regulator doesn't offer the opportunity to be regulated. And Nigel, if you can go to the next slide. What we did is we tried to cover the whole region of EMEA with our survey. It was mainly based on an online survey that we did. We sent it out to about 145 third-party marketers, and 54 responded, which I think is quite a good response rate for an online survey. We also got a very good coverage of geographically of people in the UK, Europe, Middle East, and also South Africa. So we definitely feel that this survey and the conversations that we had with third-party marketers gave us a really good overview of the TPM sector in the EMEA region. And for the highlights of the survey and the outcomes of that, I'll give it back to Nigel and let him run through the slides.
Great, thank you very much. Yeah, so it's actually quite a remarkable achievement to get about a third of the respondents to participate in an online study. And I know TPMs is an interesting subject because we now have over 100 delegates. So for those of you who've just joined, thank you very much for joining us today. So what I plan to do, and this will surprise Stuart and others, is that I'm actually not going to talk for a couple of minutes because I want to really save time and get to the guest speakers today. So I'm just going to show about 6 slides, which are the headline results from this online study before we actually come to interviewing some of these TPM practitioners, which I think is the key part of this debate. So I'm really going to try and stay quiet for the next couple of minutes. And if you do have any questions related to these slides, please do send them via the chat box. I've broken the rule already. So this basically confirms that many of the TPMs we were interviewing obviously represent equity traditional fund managers, but then there are many other types as well. So we found 175, and we're actually going to show these later on during this presentation. Now, I think this does actually require some explanation. So when you interview people online, you normally ask them some questions to rank, let's say 1, 2, and 3. So when you look at the top answer, reputation of firm, I think 36 people ranked that, whereas only 4 ranked quality of fund administrator being most important. So when you look at those four for quality of fund administrator, two, i.e. 50%, ranked it as number one. So this is all covered in the report, but the most important attributes were access to fund managers, access to senior management team, and reputation of firm. And in the report, which we will be circulating from tomorrow, this will go into far more detail. But what it does show is that in the eyes of TPMs, the reputation of the firm they're looking after in the market is key, along with past performance, access to senior management, access to fund managers, and then there are others which clearly are less important. And as you can imagine, the black book of a TPM is crucial here, the depth and size of their networking, also competitive pricing, reputation of the firm, etc., etc. So hopefully there aren't any great surprises here, but there's some really interesting data coming up any minute. One is your firm regulated in the countries where you market investment strategies or funds? Many are regulated. The one exception is in France. So when you look at Germany, most TPMs are regulated. In Italy, in the UK, less so in the Middle East. There are only one or two firms that have bothered to be regulated. But it is surprising, I think, these results. But there are a growing number of TPMs which realize that if an investment management boutique in, let's say, the States is going to ask a TPM to represent them in EMEA, they will want regulation, except for in certain markets where it's not possible or not needed. So I think the next two slides are very interesting. One is what is your fee model? And then the next slide is how much you're charging. This is the report, which, as I said, we promise to share from tomorrow. Everyone will get a soft copy. So thank you again for joining to enable us to share this report with you. And I think this is definitely worth showing as well. Particularly with Stephen's help, it's been a particularly difficult exercise. We've mapped out all the third TPMs in EMEA, and it took many, many weeks of desk research, pulling in favors. And what we've done is split it between some of the core markets. We've purposely blanked out 50% of the names. Obviously, our partners will be receiving all this information, but there are many in France, and also there is a TPM trade association. There are quite a few in Germany, and we're delighted to obviously have a TPM active fund placement from Germany with us today. Fewer in the Middle East, and it's worth pointing out that there are some TPMs in London that cover the Middle East. Asking the TPMs who are part of this debate to now look at what's happening in this market. Because I'm based in Dubai, I think I'll start with Avihai in Israel, and then we're going to move west. So I'm going to stop sharing this screen. So Avihai, hi, how are you doing?
Good,
Great.
how are you?
All good, thank you very much. What I plan to do is actually ask the four TPMs who are on this call the very same questions, but I think everyone watching will find it very helpful, because the first thing I want to ask you, Avihai, is which channels in Israel are most dominant? Is it, for example, institutions? Is it private banks? phase. So if you can just lay the scene as to how your market operates.
Sure. First of all, you're obviously invited to Israel anytime, so feel
Thank
free.
you very much.
And thank you, Nigel and Stephen. So the market here is basically divided to 3 tiers. There's a tier 1, which are the largest institutions. Money-wise, you're looking at about $600 billion of AUM that's managed. That is where we invest most of our time and effort. Tier 2 would be the smaller institutions, so universities, smaller insurance companies, family offices. And the tier 3 would be the banks. We can go into how the market is set up, but through the banks, you get to the retail market. And that's still considered institutions because you speak to the banks. That's the way it's set up in Israel. We invest 90% of our time with the tier 1 institutions. That's where the money is.
Sorry, a question has just popped up before I come back to you, Abihai. This is from Gareth. Did your research show up that there's a relationship between exclusivity and retainer or commission fee arrangements? What's a reasonable and fair model for both parties, asset manager and third-party marketeer? So please keep these questions coming. So who would like to answer that question?
Sorry, myself, Nigel?
Anyone.
Yeah, I'll go. We require exclusivity. We think that covering Israel from a variety of places, either around the world or having 2 TPMs in Israel, makes things quite a mess, frankly. The market in Israel is quite small too, so there isn't that much to spread around. So we prefer exclusivity, and we normally charge the same fee, so that wouldn't change anyway.
Okay, great. Thank you very much. Okay, Abihai, but coming back to you, could you just quickly describe your business and main activities?
Yeah, absolutely. So we are regulated. We are part of a large investment house in Israel. I've partnered with them a year ago. What we do is we represent global managers vis-a-vis those institutions that I just mentioned, so tier 1, tier 2, and tier 3. We represent mutual funds, ETFs, and investment funds, so being private equity, real estate, infrastructure. That's the business, and that's all we do.
Got it. Thank you. And what, in your view, are the opportunities and challenges facing TPMs at the moment?
So the challenge, there's quite a bit of challenges. The market is saturated with either sort of direct coverage from the managers themselves or TPMs of sorts. What you try to do as a TPM is to find what is relevant for the market. We normally don't go for the large boutiques, for the large supermarkets, but rather for the smaller boutiques that do a few things really well. That's what the market here requires and wants. The challenge is to find funds that have done well and you think will continue doing well into the future, or else the clients will sell the fund. And it's to put yourself on top of the pile vis-a-vis these institutions when there's probably 100 other competitors. So those are the challenges. Fees coming down is also a challenge. Across the world, ETFs are very strong now, much stronger than they used to be. So the opportunity on the other hand is the institutions in Israel versus, let's say, 10 years ago, invest in everything. So the market is very much open to anything. So that's the big opportunity.
Great, thank you. Just one final question. There's a myth about TPMs that they typically represent boutique managers. What's your experience in Israel? Are you representing typically boutique, or do you have very large asset management companies on your books?
Yeah, so I guess a boutique is it's a general word, right? We, for example, used to represent Pioneer and Henderson, and we call them boutiques, right? What we mean boutique is we're not talking about the $1 trillion investment houses. We love the 50 to 150 around there, $50 billion in AUM, because we find that that's where the value is. It doesn't mean that we don't touch the 2 and 300 billion, but we don't touch the 1 and 2 billion. Try to be somewhere in the middle.
Right.
Yeah, Nigel,
We look at everything.
if I can add, that is a bit of so Israel is in that sense a little bit of an outlier, because I think in most markets it's typically boutiques, as in sort of sub 30 to 50 billion or even sub 20 billion, whereas in Israel it takes a lot of assets before you open an office there, and there's some very good TPMs locally. So I think in general the boutiques are more represented by TPMs in Europe. Israel is actually also covered with large managers, and more also represent quite a number of large managers.
Yeah,
Right,
absolutely.
thank you. Great. Well, thanks very much for your time, Abihai. I've just had a TPM in France saying we are regulated and it's necessary. So please keep adding your comments and questions. So let's now move on to Italy. So Core, welcome. Hopefully we can also meet in person one day. So thank you again for your support. Core is with Garnell Capital Partners. So I'm going to ask you the same questions, Core. And the first one is, again, looking at the most dominant channels in Italy. If you could summarize, that'd be great.
Yeah, sure. Thanks, Nigel. Thanks for having me. Thanks, Stephen, also for organizing this. As with Israel, you're very welcome also to visit Italy, obviously, this summer. It will be great, I guess, to have a bit of a normality again at the beaches here and in the mountains. I think if you look at Italy, it's one of the largest savings markets in Europe. The Italians are huge savers. That cannot be said from the Italian government, but for the Italians themselves, yes. So there's a large private savings pile that is mainly managed by large banking groups, both private banking and retail, and partly also by large insurance groups. So the main channel traditionally is private banking in Italy. That's where the large concentration of assets are. That's where obviously we focus as well, because there's a lot to be gained there, and there's a lot of space for a lot of boutiques as well as larger asset management groups. Traditionally, the private banking market has been very open, so it's an open architecture model that they use. Having said that, it's very much also brand related when it comes down to retail distribution, obviously. So that's one of the characteristics. So that is one of the first focus. Then, if you look into that segment, it's mainly focused on the professional fund use. So within discretionary mandates for private banking, and for some specialist strategies, you can also look at advisory business. That's large in itself. But if you look at the rest of the market, there's an interesting segment also in the institutional space, especially on the pension fund, segment, which is not very large when you compare it to more developed pension systems like the Netherlands or the UK, for that matter. But the interesting part is that it's very much growing. And it will grow in the foreseeable future. So obviously they need to give a huge boost in the pension system, and they're quite open to all sorts of specialist investment strategies, and they're increasingly open towards international players as well. So whereas they used to have a huge home bias, Italian govies and Italian equities, etc. There's now more and more openness. So you have a growing market in terms of assets, and you have a growing market in terms of interest in international boutiques. And the same goes for foundations. So there's a large asset base of regional foundations in Italy, and also they are increasingly looking for international solutions. So yes, very, very interesting and growing market in that respect.
Great, thank you very much. And if you can just quickly describe your business and main activities, and also answer the question about which types of investment management companies do you typically represent?
Yeah, so we are a TPM organization, so a classical TPM organization. So in that sense, actually, as in line with what Stephen said, we are more focused on boutiques rather than very large firms. And I think boutiques for us are specialist players that have a sufficient asset base to have a marketing budget that allows for international expansion, not just home market activities. And I think typically you're looking at the 5 billion plus segment there. So we would target 5 to 50 billion, if in fact, in terms of asset base. Specialist boutiques, they need to have a solid reputation, and they need to have a distinctive product offering and performance. And as Javier said, obviously we need to be convinced that that performance is sustainable in the future as well, because obviously we're putting our reputation and our network to work, so that needs to be in line with the quality of the strategies and the managers that we represent.
Great, thank you very much. And just finally, what about the opportunities and challenges facing TPMs, particularly in Italy?
Yeah, so yeah, I think it started with the opportunities. What you do see is that active management in general, active asset management has gone through a rough decade, you could say. So there's a lot of pressure in these firms in terms of costs, and obviously distribution is usually the last part where they tend to cut. But increasingly we see that managers that are going through a bit of a rough time are cutting back on local representation fees. So there could be an opportunity to actually say, listen, we can take over that activity, even maybe taking over the resources that they have, and provide a bit of a more flexible model in terms of costs. So and share those costs across various asset managers. So I think that's that's an opportunity, I think. And what the opportunity is for clients, obviously, is you get instant access to a very senior network. So you don't have to go through the bothersome process of getting to know the local people, getting to know, setting up a local structure, and managing local resources. It's a bit of a more flexible model where you get instant access to senior people. So that's an opportunity. And there's an increasing interest in high quality boutiques, especially in specialist areas, like for instance, I don't know, infrastructure or sustainability or those. So there's a lot of space for these players to actually grow, if you provided you have the right product at the right time. If you look at the challenges, I think, as Javier said, that there's a lot of pressure on margins. So you know, if you look at margins, obviously we have a success fee as well, and that needs to be part of the management fee that the end client pays. If there's too much pressure on those margins, then obviously the model doesn't work anymore. You could actually ask, if you squeeze those margins too much, you could actually ask if the asset management model works anymore. But that's a different question. And one of the challenges that we face as well is that there's sometimes a bit of a short-term focus on results. So it's a bit, you know, it's a relationship type of business. You need to be in the market for a while. They need to, the Italian market needs to get to know you. They need to get to know the house, the people behind it, etc. So it's not, you don't get instant results, and that sometimes is a challenge. And obviously we say that immediately when we start speaking to clients, but that's always a dynamic that you need to manage. But that's not very different from an internal sales organization, I guess, but inherent to the sales process in itself.
Great. Well, thank you very much. Really appreciate it. Someone's asked, why is everyone wearing a white shirt apart from the lady? I didn't ask for the speakers to wear white shirts, I promise you. There are actually loads of questions coming in, which is good, but I think we'll keep them to the end. So let's move to Germany now. So Andreas Kumat, welcome. Active fund placement. Same questions for you, Andreas. First of all, which channels are most dominant in your home country?
Yeah, first of all, thank you, Nigel and Stephen, for organizing this. I would split the market in two segments, wholesale or fund distribution and institutional on the other side. And for us, they are equally important. And when you look at it, for instance, saving banks play a big role in the fund distribution, but then you have to distinguish what part of the saving banks is actually open for third-party funds and which part will only distribute internal funds from their own asset manager. And then you come maybe to the, like it was said before, the top tier saving banks who are open in their architecture, and the remainder is basically closed, and there's not much business to do if you want to enter the market. So then when you look at it further, you have private banks that play an important role, independent asset managers, and then for us also very important are fund of funds of large groups. because they can, of course, decide for the asset allocation directly, and it's a faster and more transparent process. And then when you look on the institutional side, I think the German market is less dominated by consultants than some other markets in Europe. And we see what is most important: pension funds. These are corporates. You have special pension funds for lawyers, for instance, or doctors. They are regionally organized. In each country, you have their own entity where they manage their own assets. So it's quite a diverse landscape that you have to cover. And then also, of course, insurance companies.
Great. Well, thank you very much. And could you just quickly describe your business and main activities?
Sure. First of all, we are also a licensed company. We focus in the core on UCITS funds, but we also are open for any form of open or closed-end structure with our license. We are a team of 6 people focusing on German-speaking Europe. We are not product specialists that we would say we do only equity or we do only fixed income or only alternatives. In this sense, we try to follow a bit the market and the market demand and where we see growth opportunities, and also, of course, what was mentioned already before, where you have an opportunity where a new market segment is opening up, you identify a good manager of the segment, and then you can, of course, make a good business out of it as a TPM. So that means for us, we have a portfolio of partners, we have a portfolio of strategies, which is fairly diverse, and that is probably what I, as a owner of the company, would say that's our risk management. So because we cannot anticipate everything.
Great.
And the core is just the last core is, from our perspective, to understand the needs of the investors, and this is where our process really starts.
Okay, brilliant. Thank you. There are some questions for you, but I'm going to come to them at the end. So our final TPM guest is Luke Reeves from my home country in the UK. So welcome, Luke, from LGBR Capital. So Luke, can we see you on screen? Brilliant. There you are. There you are. Yes, we can see you loud and clear. Welcome. Hopefully we'll also meet in person one day. So Luke, same questions for you. First one's, which are the most dominant channels back in the UK?
I suppose there's a couple of answers from our side. Is that the pension funds are clearly the largest by assets under management, and that they're about 2.5 times the size of the wholesale market. But the flows, certainly over the last sort of 5 to 6 years, are pretty much equal. So we spend a lot of time really focusing on the wholesale market, because that's common with quite a lot of the markets. The institutional markets are sort of controlled really by a lot of the consultants. Therefore, it's a longer journey to actually be in front of these guys and actually raise some cash. The wholesale market is a substantial market. It's about 60,000 sort of individuals, about 23,500 firms, of which about 9,000 focus on investments.
Got it. Thank you very much. And could you just quickly describe your business and main activities?
Well, no surprises in that we're a third-party marketer as well. But we are, as common with a lot of the guys here, is that really we would sort of place ourselves more as the outsourced sales side. Unlike my background at the moment, we are actually based in an office. We're COVID restricted at the moment, but we're quite big. As you can see, focus on the wholesale market. We directly focus on about 9,000 firms. So that's about, we need a big team to be able to do that. So we've got about 50, 55 people that help us execute that strategy. And you know, the main things for us is that we agree the strategy with the manager, we work out that distribution strategy, and then we go off and execute it, and we report back on a monthly basis. And in common with a lot of the guys here, we're regulated as well.
Oh, okay, I was going to cut by the FCA, of course. And then, in your view, what are the opportunities and challenges facing TPM specifically in the UK?
I think the opportunities are pretty broad. You know, sorry. Am I back on again? Yeah. So the opportunities are broad. We've got lots of managers that are looking at, falls into 3 camps. We've got overseas managers, we've got the large managers, as well as we have boutiques. We're looking at third-party marketers or outsourced sales a nice cost-efficient way of actually providing access through to the markets and raising capital. So we see that a lot. That's a big opportunity. For us, I agree with everyone else what they said at the challenges. I think probably the one thing that I would sort of add on to the challenges is really that it needs to be a big partnership how we operate with our managers. It may not be interpreted correctly or illustrated correctly that what we do is when we work with our clients, we're actually working quite closely with them, and they tend to quite like what we do. We have a strong alignment of interests in that we want to bring good quality, good performing managers to them because clearly they want to invest in those sort of managers, and clearly it's a little bit easier for us to sell those sort of managers. So we have a nice alignment of interests, and we can't compromise that for the sake of a quick sale or anything like that. Not if we want to be in business for the length of time that all of these groups have been in.
Great, thank you. Just quickly, what sort of investment companies are you representing size-wise?
We actually we're operating those three areas that I said. So we have some overseas managers, so US and Asian managers. We also work with some big, large entities in the UK where we just look after their wholesale side. They look after the institution, and then we look after boutiques, which is the whole range.
Got it. Any from the Middle East who are looking to raise capital in the UK or not yet?
Not yet. Yeah.
Okay. Well, when we meet in person, because I'm coming to UK via Greece, we'll have that conversation. Great.
Superb.
Thank you very much for your time. The questions are still coming in, which is great. We also have over 100 participants, which is fantastic. So thank you for remaining on this call. So let's talk now about our partner firms, because they have some cracking ideas to share as well. So we're going to start with Stuart Alexander, who many of you will know. He runs GemCap. So welcome, Stuart.
Yeah, afternoon, Nigel. Afternoon, Stephen. And thank you, like everyone, for having me on.
My pleasure. Nice crisp white shirt. You win the competition.
Brand new today. For you.
Thank you. So we've obviously been talking about outsourcing. I know that's one of your pet subjects. So for those who are watching, could you explain what is the role of a ManCo and what are the benefits for an investment management company? I'd also find this very helpful.
I'm going to answer it in a bit of a long-winded way, which I know is quite unusual for me. We have to understand where the management companies come from, why they developed. And it was for two reasons. Primarily, the initial reason really was because of the regulatory framework. And I think there's a better speaker on this will be Gail, I would imagine, on this. But the regulator was very keen to ensure that businesses had boots on the ground. So the development came from self-managed investment companies. So fund managers was establishing in the likes of Dublin and elsewhere purely outsourced solutions. They were coming from the US or coming from the UK into these offshore jurisdictions and just effectively outsourcing everything. And the regulator turned around and said, not too keen on this. You need to put people there. You need to have objectivity. You need to have responsibility and accountability within your business there in the jurisdiction that you are basically creating a business from. So that was the first thing. And then the other element was actually the fund managers. And obviously they would created these self-managed investment companies. With the regulator putting more pressure on them, they felt obliged to create management companies. And in effect, if you think about what an investment manager is about, and I don't know investment managers on the call, hopefully there are, but investment managers are very good at running money. That's what they do. That's what they do 24/7. But they're not necessarily, and that adds value. That's where they do add the value. But actually running the fund isn't an added value proposition. It is purely a structure. It is just the thing you create in order for an investor to buy your strategy. And that doesn't add value. So why would a fund manager do something which doesn't add value? It doesn't make sense. Why don't you outsource that? And outsourcing it to a management company and into a funds business in Dublin, like GemCap and others, enables you to focus on other things. And in effect, what we are is we provide a regulatory infrastructure. So we do everything else. Now, In recent times, some of you may be familiar with CP86, which is brought in 2 years ago now, I think. I'll get corrected, I think it's 2 years ago. And that effectively is 6 different functions. And you've got investment management, you've got fund risk, operational risk, distribution, capital and financial management, and regulatory compliance. What that means, in effect, those 6 functions, and the designated person for distribution oversight within the business, means that those individuals have responsibility to the company, to the fund's board, to ensure that those things are done correctly and effectively and efficiently on behalf of the fund and the investors. And obviously, that is what a fund's board is there to do. A fund board is there to represent the investors. It's not there to represent the fund managers. It's there as an independent body. But also those 6 roles therefore ensure a strong regulatory framework, reducing risk, etc. And the other thing to do with a Manco, of course, from an investment management point of view, is that you de-risk your business. It's a significant amount of risk involved in running money. We all know that. And having bodies and parties who take that on, de-risk your own business. Particularly if you sit on a platform like, say, JamCap, you're also de-risking from a capital point of view. You don't have to put the capital into the business. You can allow capital, in the case of us, our capital sits behind the company, sits behind the fund, and therefore reduces your capital exposure. So there are many businesses that benefit from that. We as a Manco we're not a third-party Manco. A third-party Manco has lots of different providers supporting it. We only have the one supplier, which in this instance is RBC, Royal Bank of Canada, and Pat and his team support us with the one platform that we have. Whereas others like Khan and KB, shouldn't really mention them, they have multiple different suppliers.
Don't worry, we'll edit that out. No problem. No, thank you very much. And obviously your Manco's in lovely Dublin. So why are you in the Republic of Ireland, besides obviously the people and the Guinness, which I know you love? So what's the attraction of, let's say, Dublin versus other jurisdictions?
Well, it's a very simple answer to that. The way that I look at it is I had 2 choices from an offshore. Well, actually, I had many choices. And the serious choices were the Luxembourg and Dublin. The other choices were the likes of Malta, Gibraltar, etc. And then there's reputational issues there. And I'm not going to go into what those are, but those who would know would understand what I'm talking about. When it came to the choice between Dublin and Luxembourg, there were a number of issues, a number of questions I had to answer. One of which was capital required, and it's significant in Luxembourg. Time and time to market. Dublin is much quicker. It's slowed up a bit in recent years, and that's probably because of the amount of demand which is going into the regulator. But also a common language. Dublin has a great supply of work, of employees, some great people there, and I have nothing but praise for the workforce in Dublin, and that is highly qualified. I mean, we were recruiting recently, and I had like 200 CVs, and at least half of those people had master's degrees. For someone who's got an O-level, I was mightily impressed with the quality of the workforce. On top of that, you also have the benefit of being able to distribute into the UK quite easily. Again, a common language, a common understanding of things across the Irish Sea. Gross dividends from funds being paid into the UK, and 80% of our assets are held by UK investors. And also legacy, and the fact that a lot of UK companies have been in Dublin for many years. In fact, I know I don't look it, but I started in the industry back in the mid-80s, and I was part of one of the first fund management businesses, a firm called Morgan Grenfell, for those who remember them, launched a funds business back there in the late 80s. And we were one of the first fund management businesses doing that out of Dublin. So there's a 30 odd years of distribution and management association with Dublin. So it was a no-brainer from my point of view.
Okay, great. Well, thank you very much for your input. We're now going to move to Gail, who's a partner at Pinsent Mason. So, Gail, thank you very much for your patience, and also to you, Pat, who will be appearing next. So, Gail, a couple of questions for you. First of all, can you hear and see me?
I can indeed, yep.
Great, welcome. Hopefully we'll meet in person as well one day, so welcome. How has the regulatory environment impacted managers, their ability to market funds?
Good afternoon, everyone. Yeah, the regulatory environment has had a significant impact on the distribution of funds, and particularly within the EU. Brexit, in my mind, has had the most significant impact. So while UK managers can still act as investment manager to Irish, Lux, and other European fund structures, their ability to raise capital across the EU has been curtailed due to a loss of passporting permissions. However, how managers are impacted depends very much on their marketing model. So there's no one-size-fits-all approach to this. For instance, managers that appoint and outsource the distribution of their funds to third-party marketing agents, in my view, were less impacted than managers who have internal sales teams that were actively selling their fund products from the UK. They seem to be more impacted by Brexit than the former type of managers. The managers with UK sales staff have needed to, as a result of this, rethink their whole distribution model and consider whether or not to continue these activities from the UK. So in effect, Brexit, combined with Europe's growing demand for increased substance on the ground, which is what Stuart alluded to as CP86, has resulted, I think, in managers really rethinking their whole distribution model. And what I'd like to do is maybe summarize the options that I've seen various managers look at, and maybe set out a little bit of context behind when an option works well for managers and what type of managers choose each option. So I suppose the first option that I've seen managers look at is the obvious one of establishing their own entities within the EEA. Predominantly, the vast majority were set up in Ireland and also elsewhere, to obtain the necessary permissions that would permit them to continue with their distribution activities across Europe. So this route is quite an effective route and an obvious route for a manager to consider. But as a result, and this is why I think Stuart was alluding to the CP86 review and various other reviews conducted by other regulators, there's this growing need for local substance now if you're looking for permissions in an EU jurisdiction. And as a result, if you do go for your own license, it can require potentially a lot of substance in that local jurisdiction where you're getting the permission. So generally in Europe now, this equates to a minimum of 3 full-time staff on the ground in that jurisdiction. And it depends on the size of the manager and the complexity of the application. So it can in fact even be higher than this. So as a result, typically we would only see the larger managers going down this route. And I would say probably, now there are obviously exceptions, but typically managers with the 5 billion plus at least AUM mark deciding to go down this route because it is quite costly. I have to talk about reverse solicitation just to clarify what I've seen in this regard, because it does come up a lot in conversation. So generally, this is considered to be a risky route and is usually only used to accept 1 or 2 genuine requests that were not solicited by the manager or its agents. Given that it's not clearly defined in most EU member states and cannot be relied on by its very nature as a marketing model, because you're not meant to be marketing if you're relying on a reverse solicitation exemption, managers typically do not rely on this exemption other than in very limited cases, and that's certainly been our experience. The next model a lot of managers have considered has been trying to avail of the tied agent model or a secondee route with a third-party authorized manager. There has been reluctance in some jurisdictions to permit this model, including in Ireland and I believe in Luxembourg as well. And the use of secondees was recently questioned by ESMA. So this model is under scrutiny. However, that being said, there are a number of EU member states that do permit this model, which include Portugal, Malta, and Germany. However, one thing that should be borne in mind, it works well, I think, if you only want 1 or 2 sales staff seconded under the model, but there is a fee per secondee, so it can get quite expensive where you have more than 2 sales staff looking to avail of that particular model. The final model then, I think worth mentioning, is the outsourcing model and outsourcing the marketing to a third-party marketing agent. And this can be done in a number of different ways. So it is possible to simply appoint a local third-party agent in each local jurisdiction to carry out the marketing, or which is a common enough used model. Or alternatively, you can use the distribution services of a third-party management company, which is the model alluded to earlier by Stuart. A number of third-party management companies like GemCap are more and more focused now on the distribution and marketing of funds, and will provide a distribution capability with their management company offering. I would say care needs to be taken. You do need to ensure that you fully understand the marketing model proposed, as they can vary significantly from manager to manager. For example, some managers are linked in with local agents and can sign you up on their platforms. Others offer introductions. Others offer a member of their team to accompany the investment manager's sales staff to marketing meetings. So it really is quite a diverse range of models out there, and you need to make sure that the model works for your business. So definitely the regulatory environment has, and particularly Brexit, has impacted on the sale, on raising capital and the marketing of funds, with managers looking for a wide range of different options.
Great, thank you very much. Just another question quickly. Do you think the new EU cross-border directive will make life easier for managers marketing their funds across the EU, which I know is a hot topic at the moment?
Yeah, and it is due to be implemented on the 2nd of August. And in most EU member states, we still don't have the final legislation yet. So we have to see how that one's going to pan out. But I certainly think it is the intention behind the legislation to make life easier and to enhance the marketing experience across the EU. And by and large, I think that the directive does do this by removing the requirement to have a lot of the administration and red tape, such as having local based facilities agents, clarification around pre-marketing activities, which allows managers to test the waters a bit before having to fully register for sale and incur costs, which is all very helpful. That being said, there are a few areas within the directive that could cause a few issues for managers if they don't stay on top of the new changes. So for example, you have to give notice of a change to your registration for a UCITS fund, not only now in the host member state, but in the home and host regulator state. You have to do it 30 days in advance of the change, which is going to be quite difficult, I think, for a lot of managers to adhere to, and is not currently required under the UCITS directive. So it hasn't yet been implemented. We'll see what happens with the final legislation, but I think some member states are still going to gold plate, and there are still going to be local requirements that you have to be mindful of. I would suggest using a dedicated global fund registrations team that can help. Will be very familiar with the requirements in this regard.
Great. Well, thank you very much, Gail, for your insights. And then finally, but not least, we have Pat. Pat, can you hear me?
Yep, I can hear you, Nigel. Thanks very much.
Good to see you again. So, Pat, it'd be good to just get your feedback on why RBC was so interested in this project and how you're actually going to use the findings going forward.
Yeah, well, firstly, I just really enjoyed Gail's free consultation there. I've got to say, really helpful. Yeah, look, we're a bit of an outlier, I guess. We're a service provider to the fund world, but we specialize, I guess, in the European fund space. But we're not directly involved in an advisory way or an execution of fund distribution quite in the same way that the other members, I guess, of the panel today have been involved. And, you know, in many respects, we see ourselves as an insight-led organization, and think that this is an area, we're a one-to-many service provider, so we see the market, and this is an area which I think has historically been quite opaque, but is increasingly important in light of, I guess, the macro geopolitical landscape that we've got, and Brexit in particular. And I guess having the ability to effectively cast some light on the TPM world across Europe, help guide our clients in the right direction, and help them grow, effectively ensure some mutual success for both ourselves and them.
Great. Well, thank you very much for your concise answer. Really appreciate it. Again, I hope to meet you in person one day soon. So let's just finalize by looking at some of the key findings in the future for TPM. So these are some of the thought leadership articles that will appear in the report, which, as I promised, will be sent in the next day or so. Our report does basically summarize what the outlook is for TPMs. It does seem to have a very rosy future. I had my first dealings with TPM when I worked at Thames River Capital many decades back, and we appointed a firm in Asia that did so well. In actual fact, they beat the sales in many other territories where Thames River had people physically with offices. So I do believe in TPMs. They seem to have a very rosy future, particularly with investment management companies under such pressure on the margin front. So I'd like to thank everyone, particularly the speakers today, for their contribution, and for all the delegates. We had a great number and many of you stayed on till the end. So thank you for your questions, which we will try and answer. And given the success of this report, we'll probably do a Mark II next year, and we're also looking at doing a TPM project in Asia. So thank you very much for your time. Stay safe, everyone.